Okay, welcome back. And this time in the Bulletproof Your Portfolio series, we're going to be looking at income methods. Now, I actually am only going to show one income method out of our six because it's what everyone's familiar with. It wouldn't be fair to my paying subscribers to give away income methods number 2 through 6. But there are 6 different ways to take money out of a stock without selling it. Most folks are familiar with selling covered calls, but and we're going to show how that's done. I actually do that in my account, but only the radioactive way. I don't do it in such a way that it risks an undue amount of money. To review, we have 12 stock positions protected by put options. Our initial deposit in May was $100,000. After close of business on October 29th, we were at $110,578.21 after commissions. That's about a 10.5% return in 6 months. Now, that's not remarkable. What's remarkable is the fact that we have guaranteed by the put options, $96,000 of the account is guaranteed, and we have cash on hand over $4,000. So the guaranteed amount back, no matter what the stock market does. You know, on October 29th, 1929, stocks crash. Well, I'm not too concerned about that because no matter what happens, those put options guarantee my account to go back to $100,000 even. Now, that's not the present value. The actual present value, again, is $110,578.21 after commissions. Radioactive trading is about teaching folks how to not think about timing trades anymore, but learn how to trade time. And if you look, this is a risk-reward graph that I pirated from optionsexpress.com. That's my broker. I don't mind giving them a little free plug here, but I'm also going to point an eye at a fault, a fallacy that's out there right now. If you look at the protective put chart here, it's properly depicted as being bullish strategy. The risk is that it's a safer risk strategy, and the reward is unlimited. That's right. There's no limit to how high you can allow a stock to go, but there is a limit to how far it can fall and how hard. Well, after we take on a small amount of risk, we want to learn how to use the income methods for income to bring in money. But I've got a question. Traditional covered call selling involves buying a stock and then selling somebody a covered call, a call option, which essentially gives them the right to take that stock from you at their price if the stock is going up. Let me ask you something. Does that really make a lot of sense for wealth? It's not really a wealth option, is it? You see, it's properly called a bullish strategy here. It's improperly called safer. If you'll see on the risk portion here, it says that it's safer and that the reward is limited. It is in fact limited when you sell a covered call. Okay? Now, if you look at the top and see the risk-reward graph, it's the exact same graph as this next page, the naked put strategy. You know, if you sell a put option, you sell somebody the right to give their stock or put their stock to you at their price no matter what happens to the stock. You are horribly exposed. Yes, it's a bullish strategy, meaning that your obligation goes away if the stock goes up. But it is not a safe strategy. It's very risky. And the reward, yes, is limited. Now, if you look again at that risk-reward graph, it's the same for the naked put, we'll go back a slide, as it is for the covered call strategy. And if there's any way that you can get on a site or a publication that has nothing to gain by selling you the idea that selling covered calls is the way to go, why then they'll inform you that it's every bit as risky and the same as selling a naked put. Now, I don't mean to put down selling covered calls because I do it. I still do it, but I do it in a very special way. The way it's normally done, it's an excellent algorithm, and what that means is it'll sort. It's a sorting program. It'll sort out your losers and leave them in your account. You know, the winners will get called away. How about that? I've got this crazy idea where I just want to do the opposite. I want to get into stocks and buy insurance that my stock won't go down. And if it does go down, my insurance policy pays me something for that. And then I weed out the losers and I keep the winners. I do the exact opposite of selling covered calls. And sometimes I'll balance them. I'll use them both. And we'll show you exactly how that works. But first, traditional covered call sales. Here's how it's normally done. I just made up the stock symbol, JMP, okay? I hope that's not a real symbol. But let's say we buy 100 shares of JMP at $40 a share. And we sell to open the November $40 call at $2.40. Well, what could happen? Let's say JMP jumps. It jumps up to $65 a share. Well, that's good because it's, you know, we want to get money for our stock, and we're going to. We get $2.40 for selling the call, and we get $40 for the stock because, you know, somebody's going to pick that up. And so we get $42.40, which is a $2.40 profit, or 6%. That's a 6% profit in 1 month. Wow. And that's what the covered call gurus promise. They say, hey, you get 3 to 5% or better returns. Well, the problem is, I think you see the problem. You miss the upside. That's an awful lot of money to leave on the table when JMP goes to $65 a share and you've sold a covered call at the $40 level. Oh my goodness, you have to say goodbye to that stock at $40 a share. Well, that's not so bad. Here's the really dark side. What if you bought 100 shares of DOG at $40 a share, and you sold to open the November $40 call at $2.40, and then you find out that dog don't hunt. Dog is dead, and it's down to $20 a share. Well, what do you get? If you sell now, you get $20 a share for your stock. You also get to keep the $2.40 premium that you garnered for selling a covered call, and you end up with a 44% loss. Now, the covered call gurus will tell you, well, it's not a loss until you sell. So you just don't sell. But I've got news. Sometimes stocks don't always come back after they drop off. This is Overstock, recommended near its top by a top covered call guru. And I don't know when it's going to come back to its original levels. Now, in contrast, I'm going to show you an actual radioactive trade, a radioactive covered call trade in progress now. But first, the setup. The setup is always with a married put. On October 10th, I picked up 200 shares of STP, SunPower Tech, and at the same time picked up 2 March $45 put options. Now, SunPower Tech was trading around $40 a share. Does this sound familiar? Okay, it was $39.99, and I also picked up those options, the put options, for $8.10. Now, some folks bite their lower lip and say, wow, that's expensive. Not so. Not so. Because, look, the total invested is $48.09, but the guaranteed return is $45. No matter what happens to that stock between now and March expiration, I get $45 back. So my total at risk is the difference, $3.09. Well, STP did exactly what our stock JMP did. It jumped. It went up to $65 a share. Was I obligated to do anything? No. And guess what? Here on October 29th, what I decided to do was sell 2 November $65 calls at $3.10. Now, I've got a question. If $3.09 is all I ever had to risk, and I just collected $3.10 for taking the obligation to sell STP at $65 a share, what can I lose? Nothing. I am bulletproof, just like the rest of my account. Well, and if STP crashes, so what, right? But if STP goes up or stays right at $65, I get called out at $65, well, that's a 41.6% profit. I guess that's okay. I guess I can deal with that for a 5-week hold. Don't mean to sound too cocky, but the thing is, the holy grail of trading is not about trying to squeeze every last dime out of a trade. It's about limiting your downside and then letting that stock do what it wants to. There are 6 very different income methods for canceling the risk that you take on, and I use them in different situations. What you saw just here was income method number 1, selling a covered call, and I give that away free. Some folks think that it's worth charging $3,000 for, but I give that away for free. come to my site. Don't time trades. Learn to trade time. And you can get a free subscription to all my setups and income method number 1 trades. Free webinars every Tuesday and Friday. Tuesday at noon Eastern Time. Friday at 6 o'clock Eastern Time, 6 o'clock p.m. that is. And I hope to see you there, and happy trading. We'll see you in the next video, which will teach you how to weed out the losers. Bye for now.